to me, we were at the forefront of doing big data analytics before big data analytics was a buzzword.
This was back in the day before we could just, take on millions and millions of records. We had to come up with a whole stratification scheme.
I do remember there was a pause, and some of us looked around, and we basically said, holy that's a big idea.
What's an A credit and what's a B credit, and what's your version of an A credit? What's your version of a B credit? And I remember thinking, we have solved this problem.
What I'm most proud of is the way we got ahead of the regulatory issues.
Ultimately, it became clear that it was a key component in our economy.
That more robust credit economy, that reduced cost of capital, contributes to a stronger economy overall.
Yeah, the biggest impact, I think, is on the availability of credit to people who need it the most, the availability of credit in a fair and transparent way. Those, I think, are really important.
Thank you. It was the late 80s, and I was straight out of school. That's me, fluffy hair. I came to FICO, known as Fair Isaac at the time, to work as a data scientist. This was one of the few jobs where I really had a chance to use my stat degree, and I was drawn to work here because of the people. They were, shall I say, nerds with a business vision, and I loved it. I fit right in. And I became part of this group of people who believed with a passion that better business decisions can be made with a little math. Like many of my colleagues, I started by building custom credit scoring models for lenders. By this point, credit scoring was prevalent amongst larger lenders, but there were still many, many lenders that had never used credit scoring before. And from my own experience working on these projects, there were some very common beliefs of risk managers who were new to the concepts of scoring. First, many of them believed they knew a good or a bad when they saw them. They assumed everyone they turned down would have defaulted, and that everyone that they accepted is going to pay. And often they would say, I've never booked a bad loan in my life. And our response when they said this was that if that's true, then that means you're being too conservative, and you're leaving opportunity on the table. So for example, I was working with one client who we were building a credit score model for retail, for a women's apparel, a credit card. And the risk manager was saying that he didn't think they really needed a credit scoring model because their target market was doctors' wives and stewardesses. And of course, that was meant to say that, of course, that demographics is going to pay their credit card bill. It was around this time that the FICO score was being developed. And as Larry Rosenberger recalled in the video, he's the one who bleeped himself. He doesn't remember who had the initial idea, but they said that it was a big idea. So the idea he was talking about was to use a second snapshot at the credit bureau for performance. What that meant was that we can build a credit bureau score that leveraged the experience of all the lenders in the industry and not just the experience of one lender. And what that meant is that with the introduction of the FICO score, lenders of all sizes could now use the most advanced risk management tools. And it also meant that sophisticated lenders could still expand their portfolio beyond their previous experience. Going back to the lender who aimed for doctors' wives and flight attendants, this meant that even without prior experience, they could target customers of all stripes. They could target teachers and writers and librarians and roller derby queens. As long as they were creditworthy, they could open up the market to them. I'm here to share the story of the early years of FICO scores and our quest to make credit more fair and accessible. Now, to do that, we needed to gain adoption of the score. And we faced many challenges, and they made us stronger. And everything learned today, back then, or we learned back then, is important today as we try to increase financial inclusion around the world and solve the problem that Prasanna talked about yesterday of being credit invisible. So I'd like to start the story back in 1989, and that was when I joined the FICO Scores group as the first product manager. The first challenge we faced toward adoption was to build a score that could be used universally by lenders. So the concept of interoperability, it's commonly known today, right? Most people understand that open, interoperable systems provide a frictionless environment for a network of users. But our key thinking was that for lenders to adopt the score, they needed to make sure that they can use FICO scores from any of the credit bureaus interchangeably. I mean, you see back then in the US, the coverage and the data had more differences across credit bureaus than you have today. And lenders would regularly conduct analyses to determine which credit bureau they would want to use by zip code. So we needed to figure out how to take the data from all three of the credit bureaus, right, and build specific models for each of them that maximize their unique assets, but still could be used interchangeably, so that a 700 meant a 700 regardless of which bureau that you were pulling your score from. This had never really been done before at this scale, but this is where I quote Larry again, as he would often point out that tough problems, FICO loves tough problems because it gives us an advantage. So the key part of the solution here was a common design blueprint and gaining deep experience, expertise on the differences in the underlying data. And as a result, the FICO score we created was the first broad-based model that could be used interchangeably. It allowed lenders to choose the strongest bureau at the zip code level and expand regionally with ease. This was just one of the ways that having a standardized score has helped grow the credit market. Even lenders outside of the US have expressed interest in a broad-based universal coverage score as an opportunity for market growth. Our next challenge for broad adoption was helping lenders navigate the regulatory environment. Regulators and policymakers at the time had little understanding of credit scoring. So lenders were understandably concerned about having to defend their practices. As a case in point, there was a Wall Street Journal article about Lawrence Lindsay. Lawrence Lindsay was a governor on the Federal Reserve Board who got turned down for a Toys R Us credit card because he had too many inquiries on the credit bureau. The article cast doubt on credit scoring because how could a technology that turns down this obviously good credit risk be possibly fair for everyone? And even though the arguments made by Governor Lindsay were thoughtful, they were clearly with a genuine attempt to ensure that this new practice does not harm the credit industry, it was still steeped in basic misunderstandings about credit scoring. In this article, Governor Lindsay is quoted as saying, "We will obtain the fairness of the machine, but lose the judgment, talents, and sense of justice that only humans can bring to decision-making." This was a common belief. It fundamentally believed by many that a computer can never make better decisions than a human. So enter Pete McCorkle. You saw him earlier in the video as well, present day. He was our general counsel, and he played a key role in advancing credit scoring with regulators. In this Viewpoints article, that's between Governor Lindsay and Pete, Pete points out, first, that the best solution is the combination of the machine and the human. which is interesting that Will's keynote the other day, on that first day, said essentially the same thing. And Pete points out that even human underwriters are basing their decisions on past experience. Credit scoring just does the same thing. It just does it more consistently and systematically. And if the experience cannot be reflected in the data used to build a model, well, that probably means that the underwriter wouldn't have had it anyway. So much of the education that we had to do in those days was to demystify this machine. And the argument, we had to shift the argument from human versus machine to one about data. You use data and historical data and the best data that you can leverage consistently and systematically. We spent many years educating regulators on the fundamental concepts of credit scoring. And after spending time with them, regulators came to understand that they should focus their efforts scrutinizing the decisions that were not made with credit scoring, as opposed to the ones that were. Thus, lenders were able to navigate the use of scoring with less difficulty than they would have otherwise. And regulatory uncertainty causes inertia, especially when it comes to using new technologies. So I credit Pete for being a key figure in making the adoption of credit scoring possible. Before I describe the next challenge, I need to set the stage for what was going on in the industry. By the mid-90s, most credit card issuers were using FICO scores, but then the auto and mortgage industries started. What was interesting with these industries is that they're networked industries, right? They involve a network of multiple entities who now use the FICO score. And this opened up a new benefit of the FICO score, which is it created transparency and efficiency across this lending ecosystem. So take auto lenders, for example. In the US, many auto loans are sourced through auto dealers when they sell cars to consumers. An auto dealer will work with multiple lenders and vice versa, creating a network. So knowing the score of a consumer helped the dealers know which lenders they would be able to get a loan from and how much car they could afford. We first realized that the auto lenders were having their car dealers pull the FICO score when we start hearing about it on the radio. You can imagine our surprise when we're driving down the road and there's an advertising on the radio for a car sale by a dealer, and they say at the end, FICO score, 680 and above. So it was thus that the FICO score becomes a standard measure to communicate credit risk for lenders and others in the ecosystem to understand their risk policies or measure for the overall risk of the portfolio or for securitizations. Over time, the FICO score's predictiveness has fostered a deep sense of trust within the investor community and has become increasingly critical for responsible lending. The FICO score becoming a standard across networks of users, that created our next challenge. That's because suddenly FICO scores were becoming known to consumers. That happened because auto dealers, mortgage brokers, real estate brokers were starting to ask the consumer, do you know what your FICO score is? So it was within all of this increased interest and scrutiny that we built out more product and media support, educational content. We had a helpline and even an educational video. Once we received a call from a mortgage broker on the helpline. She'd pulled a score of her future son-in-law. She wasn't very happy with the score and wanted to know what was up. Not sure if that marriage ever happened. It was around the late 90s that we started to seriously consider providing access to scores direct to consumers. But many lenders were concerned that consumers who knew too much about credit underwriting might manipulate their scores. We conducted our own studies. We had our data scientists simulate what consumers might do, and we learned that it's really not that easy to manipulate your score. So starting in 2000, we launched myfico.com. This was followed up by our consumer disclosure program, Open Access, in 2013, which today provides regular FICO scores disclosed by banks to their customers on over 300 million accounts. And recently, we've started a new program of events called Score a Better Future. Consumers receive free education and their FICO score, introductions to credit counselors. These events help consumers manage their credit better. And the fear that many lenders had never really came to fruition. There is no widespread manipulation, and studies even show that consumers who gain education about improving their scores really do improve their long-term credit risk. Additionally, many lenders gain customer loyalty and stickiness through the consumer disclosure programs and education programs. We learned from these years of experience that making credit education accessible is an important part of the goal of making credit fair and accessible. 30 years after the initial launch, we've achieved the goal of more fair and accessible credit in many countries, but we're not done yet. There's more of a challenge left. Throughout the world, there are still 3.3 billion people who are unbanked or have no credit history. The numbers and the reasons differ from country to country, but one thing that's constant is that credit, when managed properly, is a key to economic inclusion. Credit allows consumers to get an education, start a business, gain access to the goods and the tools they need to make a living. A critical asset to help more people throughout the world is the ability to assess credit through non-traditional data. Even in developed countries like the US, there are 53 million people who don't have a FICO score because they don't have enough historical or recent credit experience for a traditional score. There are a lot of unique challenges when it comes to using alternative data, but this is where I remember Larry's tenet again, that we like a hard challenge. Gives us an advantage. So in the US, we launched FICO Score XD in 2015 in partnership with Equifax and LexisNexis. This score consumes traditional credit data, but also telco and utility data as part of the NCTUE database at Equifax, and public record and property data from LexisNexis. And we're in a pilot stage for Ultra FICO in partnership with Experian and Finicity, which looks at bank account data that consumers contribute through open banking. Our choice is to use alternative data rather than lowering minimum scoring criteria. It might be more difficult to pull off, but it's the right way to handle the issue of financial inclusion. Internationally, we've worked with several types of data that reflect a consumer's purchasing and financial habits. We'll soon be launching the FICO score for mobile money, working with Vodafone. This score is integrated into the Vodafone M-Pesa lending proposition in Africa to assess new-to-credit borrowers' risk based on their mobile usage and mobile wallet data. These are consumers, but in many cases, their borrowing is necessary for their livelihood, right? Think about the woman who buys mangoes in the morning to sell mango juice in the afternoon. And these non-traditional channels for credit, for some, will be the on-ramp to more traditional banking lending as their business needs and their opportunities grow. What we're doing with Vodafone is but the latest chapter in the FICO score story, and the reason why we're celebrating here today. We're celebrating 30 years since the beginning of the FICO scores, and when the mobile money score launches, we'll have FICO scores in 30 countries. This is a celebration of not just FICO, but many players in the industry working hard to make credit fair and accessible. And although we could not have predicted how the industry would change or the role that FICO scores would play, It's interesting now to see that the enabling factors that allowed it all to happen were built in from the very beginning. Elegant things, elegant design helps make big things happen. So as part of this celebration, I've invited some of the key players that I've had the privilege to work with who are instrumental in the development and adoption of the FICO scores. These are the people that you saw in the video. I'd like each of them to stand up and wave when I introduce you. So Pat Culhane, let's hear it for Pat. Pat was the first leader of the FICO score group. He insisted on, among many things, this common design blueprint, which enabled the scores to become an industry standard. Sherry St. John. Sherry was the first head of development for the FICO scores. She had to work through many of these horrible analytic complications, right? And then she led the scores team after Pat moved on to another role. Michael Rappaport. Michael was on the development team from the very beginning, and then he led development when Sherry took over, and through much of the adoption to become an industry standard. And then the aforementioned Larry Rosenberger. A leader at FICO, he became CEO in the early 90s. And he, along with the other leaders of the company, created the culture of integrity and collaboration and trust that allowed us to be successful. At the beginning, our mission was focused on making credit decisions more fair and expanding the credit market for our clients and for consumers, or as we used to say, democratize credit. This is what we sought to achieve, and we did it. And we did it with your help. We did it with our partners, our clients, other industry stakeholders, and it wouldn't have happened without you and many of the people who walked before you. So now, scoring, consumer education, alternative data, these are keys to helping create opportunity for consumers throughout the world, helping to lift them out of global poverty and into the global economy. We look forward to working with you to make that happen. Thank you very much.